Hello, good morning, everyone, and welcome to today's market update, the first one back of this year, which is super exciting. As per usual, I'll just give it a few moments to let anybody else hop in this morning. We're always pretty quick to get going, I know, and it's always so great to be punctual. I've got Lisa here as well. Morning, Lisa. How are you? And Happy New Year.
Happy New Year, Zoe. I'm doing great. How are you doing?
Yeah, very well, thank you. Just saying, very excited to be back for this first market update of the year, the first of 2026, which feels slightly surreal, but great to be here as well. And just as a
Absolutely.
brief, I was just going to say, just a brief recap, you can always ask questions, but I'll let you do that little bit if you want, Lisa.
Yes, no, that sounds fantastic, Zoe. I'm going to be posting a link to Slido in the chat in just a couple of minutes. You can click on that link, you can ask your questions anonymously or with your name on it. You can ask at any point in time, and Zoe will be answering them towards the end of this session here.
Absolutely. And of course, if you are listening to this or watching the recording later, because we do always record it and pop it up for you to watch, then you can always drop us an email at hello@myfinancialfreedomcoach.co.uk to ask any questions that you might have. And of course, if there is anything that you see in the news during the week that you really want just digging into, we'll do our very best to include it as well. So without further ado, I'll kick off with what we're here for. Today's Financially Speaking, your Monday morning briefing, breaking down some of those key headlines from last week. So if you're new here, hello and welcome. It's great to have you joining us in this 2026. But if you've been to a few, you'll already know the agenda. But what I'm going to do is I'm going to break down a little thing that we have done as the founders of Financial Freedom Coaching to get us that little bit closer to financial freedom in the last week. Before moving into what has happened in the UK, over the pond in the US, a read of the week, Europe, and the rest of the world as well. So, Lisa, I'd love to hear from you on the 5th of January as we are. What is it that you've been up to in the last, well, maybe not week, but the last few days to get you that little bit closer to financial freedom?
Yes, fantastic, Zoe. So I've actually got a really big trip coming up in April. I'm getting married in the US, and so I've just been planning my budget for that effectively, with that coming up now quite fast. And that's the only thing that I've done over those days because I've also just come back from holiday as well.
Yeah, it's a bit of a tough one, isn't it? I know for me, it's a bit of a shock to the system that we're back up and running because I also have been on a big trip. So a very similar one from me, but it's just been checking in on that budget. But you know what? Sometimes I think it's a good one to note as well, that particularly at this time of the year, we can be bombarded with major New Year's resolutions, all the big things we should be changing. And actually, sometimes it is about those micro movements as well. It doesn't have to be about setting yourself these whopper great targets that can feel quite overwhelming. But sometimes actually just the small day-to-day stuff is also just as important to get you closer to freedom as well. So let's take a look then at where the markets moved last week. And it's worth bearing in mind that these stats are kind of funny this week because, of course, we had major holidays in the vast majority of countries last week. And what that means is that often stock markets have been closed for a period. So whilst I always show on these Monday morning market updates, these figures from the last week, if there has been closures, it can sometimes be for like 4 days, 3 days, you get the idea. So the FTSE 100, which is the measure of the 100 biggest companies in the UK, climbed by 0.63%, so ended the week in the green. The S&P 500, which is the measure of the US stock markets, specifically the 500 biggest companies in the US, fell by 1.12%. The NASDAQ, which is the index that measures a lot of different tech companies, also fell by 1.74%. Whilst the Euro Stoxx 50, the measure of the 50 biggest companies across the Eurozone, had a fantastic week, ending up by 1.67%. Now, this week, as I say, is a slightly funny one. So how you can use these is to kind of gloss over them and get ready for what it's going to mean in the weeks, months, and eventually years to come with your investments as well. Often I find that when these figures first pop up, they don't necessarily mean a lot. But the more that you start to see them, the more you can register how much there are minor changes or major changes, but also how much we see week on week. There are some green weeks, some red weeks. It's not always a bad thing. It's just how it goes with our investments. And I often find that from an emotional perspective, the more that we can take that on board, the simpler it gets. So on to then what has happened in the UK, where speaking of that FTSE 100, the FTSE 100 broke what we call the 10,000 point mark. Now, the 10,000 point mark is just a measure of basically how big that stock market is. But it's more of a psychological barrier because the calculations that go into working out this 10,000 or indeed 9,000 as it was for most of last year and various different stages between all are, as I say, represent how much the stock market's worth, but with various of the calculations that go on behind the scenes that for the vast majority of us are relatively irrelevant. But what it does show is that actually investors are pivoting more and more towards the FTSE 100 and are potentially becoming more and more fearful of the US tech based indexes and also the US tech based investments that have done very, very well over the last few years, but are arguably becoming a little bit more expensive, whilst the FTSE 100 some may see as slightly cheaper. So what does all this mean then for you and your investments? Well, essentially what this rally reflects is that there are more and more inflows into the likes of the FTSE 100. So if you've got investments in the FTSE 100, it could be relatively positive in the short, medium, and indeed even long term. If you're in the UK, it's slightly different. The FTSE 100 is a list of relatively global companies. And so whilst those investments are coming into the FTSE 100, it's not necessarily going to impact investment directly into the UK. It might in some way, shape, or form, but don't necessarily think the two are directly correlated, i.e., the FTSE 100 and UK economic growth. But it does mean that the FTSE 100, the UK stock market, can continue to rise, even if what we're seeing at the moment is that economic growth is kind of there, but it's a little bit weaker than many want. So as I say, don't kind of confuse the two, particularly when looking at different headlines about this. If you've got investments elsewhere, this isn't necessarily taking away from them. I've touched upon there how inflows into the FTSE 100 might be because things are moving away from the US and the tech indexes, for example. It's not to say that you should flock and sell off all your investments in those areas if you do indeed have them, but rather just a topic and a theme to continue to watch as we move through 2026 and into the future as well. And as always, continue thinking about that level of global diversification within your portfolio and avoid sticking to just one region, be it the US or be it a home bias, whatever you might well have. On to then, speaking of the US, what has taken place last week in the USA? Well, it's worth bearing in mind that things seem to be changing quicker than ever with the US. Whilst we always do our best with this content, when things happen over the weekend, things can get really quite tasty. And of course, many of us may have seen over the weekend the headlines and the news around a recent conflict that has taken place between the US and Venezuela. This will inevitably affect stock markets when they open in the US today, but that has not yet happened for those stock markets. They've not opened yet in the US. So you've got to take this news with a bit of a pinch of salt. There's only so quick that certain news can keep up. But actually, what is more pressing is also the US dollar. Because while stock markets have strict opening times, often what we see is that currency markets fluctuate more frequently. They do, as FX traders have working hours, and we see certain volumes of currency trading increase and decrease throughout working days. But crucially, what we actually see is that still currency is able to be bought and sold. Now, what many are predicting is that the US dollar, which for many years has been, if not the global currency, the safe haven, the asset that is used for an awful lot of global trades, potentially faces its steepest annual fall since 2017. This is due to all sorts of factors, notwithstanding the conflict that we've seen take place over the weekend, but also off the back of a year where we've seen Trump introduce the likes of tariffs, trade wars, and we've also seen rate cuts around interest rates and a backdrop of ongoing inflation. We've also seen ongoing policy uncertainty. Now, if you've come to these updates frequently, what you'll know is that stock markets, currency markets, and frankly, any other investment markets hate more than anything is uncertainty. and what Donald Trump is doing at the moment and seemingly continues to do into 2026. We're only 5 days in, but here we are, is that he's certainly throwing up an awful lot of uncertainty. So the weekend's news in Venezuela has actually given the dollar a brief rally. So it's climbed when we compare it to other major currencies. But what many are predicting is that this won't necessarily stay this way if, and it seems certainly likely, that these ongoing political decisions, this ongoing uncertainty really continues with this volatility. So what does all this mean then for you and your investments? Because certainly the US dollar can feel quite far removed, and it can certainly, I think, with currency feel a little bit complex at best, but certainly tenuous to be able to link through to how your investments are performing and how your own personal financial position looks. So essentially, if we strip it back to the purest form, a weaker dollar boosts US exports. So that means that actually it's cheaper for us across the globe with other currencies to buy those US exports. And it can also therefore mean that if we've bought investments in dollars, so if we've got, for example, a fund in the S&P 500 that's in dollars, then it may well perform in a better way, slightly stronger, if you like, if that dollar is slightly weaker. It's convoluted, but stick with me for this early morning update. So what that means is that often people are more attracted to it. If the dollar is a little bit weaker for other global investors, both from an export position, but also from an investment position, as I just mentioned there, with funds like the S&P 500, then this can further encourage them to put money into it. This can therefore make the US slightly more appealing. They can make more money through this. But on the flip side, what a weaker dollar can also do is really stir up some of these thoughts around what's causing the weaker dollar. And it can just go to show how strong the cause for global diversification is, adding some extra appeal of the likes of the UK and Europe, which is what we've seen with that FTSE 100 boost over the last week. It's certainly a reflection on a shifting global order. As I say, the US dollar has been, if not the global currency for almost, decades, centuries, some may argue. It's the one that is used for the vast majority of global trades, and this is not to be underestimated. But with this ongoing uncertainty and volatility caused by, frankly, Trump, then what we might see is that actually the strength of the dollar continues to weaken, and this could see other currencies start to shift. It could see other areas, such as the UK and Europe, start to emerge as stronger and ever more appealing to other investors as well. So hold tight for what that brings. And I think I'll say it again, keep in mind that diversification aspect. On to then the read of the week, where the Financial Times laid out 5 simple ways to reset your finances in 2026. We started off by saying what me and Lisa have both done to sort of reset our finances, or at least take some small steps towards thinking about budgets this year. Of course, I think sometimes it takes a bit of a longer rumination, There's loads of theories around habits and how quickly they can be broken into early January. But actually, what we can also see is that sometimes those habits that you think about for a little bit longer can be the ones that stick. So this article really offers practical ways to reset finances for 2026, be it from looking to clarify assets and debt, using different tools to track spending, or thinking about things like prioritizing emergency savings and preparing for the likes of mortgage changes and also long-term resilience. So what resetting our finances in 2026 will mean will be different for every single one of us here today. For some of us, it might mean taking a look through where we're at. For some of us, it might mean setting goals, for example, on savings or how much should be invested. For others, it might be having a look in on investments, seeing how they perform, maybe making some shifts and ensuring that they're still aligned. But for all, one thing that I really urge is that you congratulate yourself, because what I often think is that particularly the further into financial education we get and the more we learn, the easier it kind of is to forget how far we've come, because you know that you know more and more, and you therefore know what you don't know as well. So make sure you take a look back at where your finances were in 25, 24, and before that as well, and make sure that you really take a look at how much they've changed, or indeed how much your mentality, your education levels, and also now your knowledge is at, because inevitably it will have increased even by just joining us today. So let's take a look then at Europe. Well, firstly, we saw the EU pressing ahead with carbon border tax on imports. So this has been an ongoing topic in 2025, and it's really about aiming to protect the domestic industry in the EU and push forward a global carbon pricing system. It has various different pros and cons. From an environmental perspective, many argue that it's great, but it can raise costs for certain industries, which in the short term can cause certain issues, including volatility, particularly in those carbon heavy sectors that are going to suffer from these changes that the EU is introducing on imports. But it really does favour cleaner, in inverted commas, firms. This can mean that the likes of ESG funds, particularly in Europe, might see a bit of an uptick, a bit of a boost. We just don't know how long that's going to necessarily last, because inevitably, when changes like this get brought in, there is a period of adjustment, a period of understanding how to adapt and how to change to it, and then eventually there is an order that is settled again. In that time, there could be a little bit of trade friction, as I say, with some of that carbon heavy industries as they really adapt to these taxes that the EU is putting in place. But usually they do start to settle. I've really said for many years now, I think ESG is becoming a much longer game when it comes to investing. The likes of Trump are setting back some of the changes that have been made to things like greener energy, cleaner energy, and other areas of ESG as well, because ultimately it stands for environmental, social, and corporate governance. Something I could talk about for hours, but of course we're on a set time here this morning, and the update really is just focusing on this small bit of EU change. But what I would say is that it's a longer game. So what it means for you and your investments, particularly if they're in more sustainable areas, is that this is a change that is moving towards a positive step. But it's unlikely to be played out really quickly in your investing portfolios. And it's unlikely to be something that you see really hit. It's not something that you're going to come away from today and be like, oh, I saw the impact of that in my investments, because it just won't quite work like that. It's too subtle, essentially. But that doesn't mean that it won't have an impact over the longer run when we're thinking about that broader category in general. And then with the EU economy, Europe's 2026 growth outlook is really hinging a lot at the moment on Germany's debt-funded infrastructure. There's a lot of talk at the moment about debt levels within governments. So the vast majority of governments will have some level of debt. Some are higher than others. Within the EU, they try and keep them at a certain level, particularly within major players like Germany. It's kind of frowned upon to have too high levels of debt, both as an individual and also as a nation. Lots of nations, Germany included, saw debt levels really soar particularly high over COVID. And then it's continued as we've seen things like oil prices increase with the invasion of Ukraine back in 22, and then ongoing inflation that governments have faced issues with into the last few years. So these higher levels of debt are really now what is impacting levels of economic growth across developed Western nations. And across the EU, a lot of this is therefore hinging on Germany's particularly high levels of debt. What this now means for the next year is that people will be having a laser focus on their defence spending amid various different geopolitical risks. Defence spending across Europe has really increased, but of course a lot of it comes from governments. Now, if the government chooses to increase their spending in defence areas, they may well have to take further loans for that, just increasing their debt levels, which could therefore in turn put various different economic pressures on their levels of debt. So what does this mean then for you and your investments? Well, what it can mean is that if we see, and likely we will, increased government spending on the likes of defence, then there could be various different investment from an equity perspective opportunities there. So stock increases within the defence sector. But modest economic growth on the flip side, means that Europe actually relies further on just a confidence front than an actual strong backing to those stock market decisions and also to the economy. So it's kind of thinking about that medium to longer term. What it could mean in the short term is that we're just really watching how that economic growth pans out and what that looks like for various different stock areas, basically. What it means for the longer term is, does this mean that it will be successful in 5-10 years and really see a boom, or does it mean it'll be a bit more flat? It's not negative. It's just one to be aware of if you've got European investments in your portfolio. It's one to be aware of if you've got defence investments in your portfolio, and certainly keep an eye on both of those sectors, geographies as they pan out, and what that means for the overall growth. And I'll say it again, it's going to be a key theme, I think, in 2026, remain diversified. And so on to the rest of the world, where first up in China, President Xi Jinping reaffirmed tech self-reliance and fiscal support. This is all about targeting growth. The Chinese economy has also struggled with slower growth, despite, and this is all sort of owing to or started with a major property collapse in China nearly 7 years ago now. But there's ongoing US trade tensions as well. One of China's main focuses is going to be in 2026, continuing to try and grow their economy at a higher rate than they have been doing over the last few years. So this reaffirmation of this is no particular surprise, but it just kind of suggests that they really are doubling down on it and will make sure that they focus on it at any cost. So what does this mean then for you and your investments? Well, China plays a major role in the vast majority of emerging market portfolios. If you've got China in there somewhere in your investments, you'll probably have seen that over the last few years, it's grown quite significantly. They want that to continue, and that desire can mean an awful lot, but there's no guarantees. It's amid a changing backdrop of weakening economic growth, which they haven't faced before. So it may well be that China does start to slow. It may well be that these new economic incentives really drive it forward. Let's just wait and see and keep our eyes open for what's to come. Into then Africa, where various different African states have expanded their central bank gold buying. This is all about capturing revenues, focusing a little bit more on the likes of curbing smuggling, but also strengthening foreign exchange reserves. Whilst the dollar faces a volatile period, many other nations will be looking to diversify what they use to buy and hold other assets. So traditionally, the dollar has represented a major part of the vast majority of nations' reserves. It may well be that they're also adding other currencies as well as the likes of gold to that, to diversify out beyond just the dollar, given the volatility that we're seeing. African states doing this in the last few weeks of 2025 and into 2026 will really go to show kind of how this diversification is panning out. So what does this mean for you and your investments? Well, if you've got, for example, gold in your investment portfolio, you'll have followed the absolutely wild ride that 2025 brought, which was seemingly endless headlines about all-time highs. It certainly seems to me that this is a story that is set to stay. Whether it continues at the same level and the same rate, who knows? But with many other governments flocking towards it as well, it certainly shows promising signs into 2026. And last but not least, where we saw Japanese equities, so the stock market in Japan, hit record highs. A lot of this has been driven by tech, banks, and defense, as well as helped by a slightly weaker yen, so the currency in Japan. As mentioned before, with the US dollar, a slightly weaker currency can be a good boost to an overall stock market. It's not necessarily a long-term plan, but certainly here we've seen it help Japan. Japan has really driven a recovery in the last few years, having languished for nearly 2 decades. If it does form part of your portfolio, if you're thinking, what does this mean for me and my investments? Well, actually what it means is that continuing to go from strength to strength and seemingly showing this strength in both their stock market and their economy too. It's definitely an area to watch as we move into 2026. So hopefully that has given you a good roundup of some of those key headlines, takeaways for the new year and the week to come. And I'll move now into any questions that anybody does have, though you can always put them in that Slido link that Lisa just shared at the beginning.
Amazing. Thank you, Zoe. That was absolutely fantastic. Really good to catch up with what's been happening over the last few weeks as well. I'll go through the questions now, and then it would be great as well if afterwards maybe you can give us a little bit of an intro to the group coaching as well, because I know that might be on a lot of people's minds at this time of the year. Okay, so first off, we're starting off with a UK question here. Can you explain a bit more the FTSE 100 rallying whilst relying on foreign earnings? I thought this was a UK index.
Yeah, it's a really good question. So it is a UK index, and companies can choose where they list, basically. So most of the time, companies would choose the country in which they're based. And for lots of years, that has been pretty obvious. Now, as we've moved into an ever more globalized world, what we've seen is that the FTSE 100 can be dominated by companies that are quite global. So some examples of companies that we might all know of that are listed on the FTSE 100 are the likes of Shell, which is an oil company, of course, but Shell's revenues are not just impacted by what happens in the UK, by what happens in many different countries, depending on where they're drilling oil, depending on where they're selling oil, depending on what's happening to oil prices across the globe as well. So whilst the FTSE 100 is a UK index, even just that as an example, you can see how many of the global incidents, if you like, changes could really impact that company and then therefore the overall index as well.
Fantastic. Thank you so much, Zoe. And then at the moment, we've got one more question on the EU. And the question is, what does this EU change mean on favoring ESG companies? It seems a bit odd given the US are setting back changes. Are long-term ESG prospects good?
Oh, yeah, good question. So essentially what the EU is doing here is they're driving ahead with various different changes, taxes specifically, to protect their home companies, if you like, and what they're doing with changes to various different green policies, carbon intensive industries. So the EU is pushing forward with more stereotypically green policies here. Or whilst, as you've said in the question, the US is actually reversing what they were doing before. So does ESG have some sort of long-term future? It's a great question. I personally believe it does. I personally believe that the planet cannot cope if we don't. It might just be longer than many of us were thinking perhaps 5-6 years ago when the US were on board with what was going on. And of course, they're a major player. So it could just pose some conflict in the meantime. But the EU is not small, you know, these won't mean nothing.
Yeah, fantastic. Thank you, Zoe. Thank you. That sounds great. And then finally, do you want to just tell us a little bit about the group coaching that we have on offer now? Because obviously before we just had the one-on-one sessions.
Yeah, absolutely. So as we move into 2026, we are really looking at what we can offer and how we can expand this. So we are now offering sign up for our group coaching sessions. We'll have a small cohort of people where we work together as a group for accountability purposes, but also to bounce ideas off each other and work together. So within the group coaching, it'll still be relatively similar to the one-on-one. We'll be working through various different financial hurdles that we all face. You'll be sent away with various different tasks and come back between each session with hopefully more progress. And we'll work together as a group within those sessions to really tackle some of those blocks and barriers that you can face within your financial situation and within your investing as well. It's worth saying that within a group, we make sure that everything's super confidential. I know that's something that people may worry about, and you can offer as much or as little as you like. A lot of the work can be done by yourself as well. But actually what we see is that some of the best results do come from sharing and really working together. So we'll be putting signups up on our website so that you can join the list. And as and when we're ready to get going with that and pick a launch date, we'll be in touch.
Perfect. That sounds fantastic, Zoe. Thank you so much for this morning. I hope everybody has a fantastic first working week in January.
Me too. Thank you so much. Have a lovely day and bye for now.
Bye for now.